Imagine this scenario. You wake up one morning, check the financial news, and once again you see the headline, "Interest rates are rising." Sounds technical and distant, but behind that single line is a powerful force reshaping investor behavior across the United States, United Kingdom, and Canada. What feels like a small policy shift is actually changing how portfolios are built, protected, and rebalanced around the world. Rising interest rates are not just numbers on a screen. They influence how people borrow, spend, and invest. Every increase signals that the financial environment is changing. Investors are forced to slow down, reassess risk, and rethink long-standing strategies that worked during years of low interest rates. At their core, interest rates represent the cost of borrowing money. When rates are low, borrowing feels easy, spending accelerates, and investors are encouraged to take more risk. When rates rise, money becomes expensive. Businesses delay expansion, consumers become cautious, and investment decisions become more selective across all major economies. Central banks play a key role in this cycle. The Federal Reserve in the United States, the Bank of England, and the Bank of Canada raise interest rates primarily to control inflation and stabilize economic growth. While these decisions are made domestically, their impact is global, sending ripples through financial markets and cross-border investment flows. One of the first markets to react to rising interest rates is the bond market. For years, bonds were largely ignored because yields were too low to be attractive. As rates rise, bonds regain relevance. New bonds offer higher yields, while older, low-yield bonds lose value, forcing investors to rethink duration and exposure. Across the US, UK, and Canada, government bonds are once again becoming important portfolio stabilizers. US Treasuries, UK gilts, and Canadian government bonds are attracting investors who are seeking income, safety, and balance during uncertain market conditions. Stock markets respond differently to higher interest rates. Growth and technology stocks often face the most pressure because higher rates reduce the present value of future earnings. This leads to valuation, compression, and increased volatility, particularly in markets that were driven by aggressive growth expectations. In contrast, value stocks and dividend-paying companies tend to perform relatively better. Sectors such as banking, energy, utilities, and consumer staples benefit from steady cash flows and reliable income, making them more appealing when borrowing costs rise. Real estate is another sector deeply affected by rising interest rates. Higher rates increase mortgage costs, which reduces affordability and slows housing demand. In Canada, housing markets have entered a cooling phase. In the UK, buy-to-let investors are facing tighter margins. In the United States, commercial real estate, office spaces under growing pressure. Because of these challenges, many investors are shifting away from direct property ownership and toward real estate investment trusts, or REITs. REITs allow investors to maintain real estate exposure while offering liquidity and income without heavy reliance on debt. Rising interest rates also affect currencies. Higher rates often strengthen a country's currency by attracting foreign capital. This dynamic influences global asset flows and forces investors to think carefully about international diversification and currency risk. All of these forces are driving portfolio rebalancing. Investors are reducing excessive exposure to high-risk growth assets, shortening bond duration, increasing allocations to income-generating investments, and holding slightly more cash to remain flexible in a changing environment. Ultimately, rising interest rates are not a threat, but a transition. Investors who understand interest rate cycles across the United States, the United Kingdom, and Canada and adapt their strategies accordingly are better positioned for long-term success. In investing, it is not about avoiding change, but learning how to move with it.